Let's bring in Jeff Saut. He's the chief investment strategist at Raymond James, where he helps oversee over $235 billion in assets. He joins us from St. Petersburg, Florida. Jeff, Tim Geithner, they're answering some pretty tough questions. What do you think? Should he be able to keep his job?
Yeah, I think he's done a pretty good job. I mean, a lot of people criticize the administration, and I'm not in favor of a lot of the things the Obama administration is doing. But Geithner and Bernanke, if they hadn't stepped to the fore, we'd really be in deep weeds right now.
Yeah, the Treasury Secretary Tim Geithner responding with smiles. But what about the markets here, Jeff? You know, we're back from the Labor Day holiday. As you said, the next four trading sessions, or we're in the midst of these four trading sessions after the holiday. Pretty strong indications as to what we'll get in the short term in the next few months or so. So what do you think of the market action so far?
I don't think there's a whole lot of downside here unless we break below 1060 on the S&P. And the Labor Day indicator you reference, history shows that if the 4 days following Labor Day into the upside, the odds are pretty good that we keep trading higher. The quid pro quo is if we end down over the 4 day session, then it behooves investors to likely wait until October for a more sustainable bottom.
Okay, so history aside here, Jeff, I mean, the first two trading sessions, you know, we had kind of a big sell-off, 1% plus losses on Tuesday. And then today, you can say minimal gains to the upside. You know, some are still looking at declines, considering we have a lot of investors still choosing to stay on the sidelines and not looking at equities still.
That's exactly right. I think we have a bubble in pessimism, just like we had a bubble in optimism 10 years ago in 2000. If you look at dividend-yielding stocks, clean balance sheets, where we don't think there's a whole lot of downside, with earnings yields, depending on which earnings metric you're going to use, anywhere between 7 and 9%, I continue to think there's not a whole lot of downside right here.
Okay, why do you think there's not a whole lot of downside? Because the selling has already been so, I guess, fast and furious over the last 2 months?
Yeah, you took 17% roughly out of the S&P. You got to extremely oversold levels. You got to oversold levels that were as bad as what we saw at the March 09 lows. You got to extreme negative pessimism levels equal to the levels we got to in March of 09. And I just don't think there's a whole lot of downside, barring some kind of policy accident right here.
What about the macro environment right now? You know, we had the Fed Beige Book talking about a significant slowdown or a slowdown in many areas of the U.S. economy. And then you still have the sovereign debt concerns over in Europe.
I have avoided Europe for 8 years. I have not much. I have interest in stock-specific companies over in Europe, but in a 50,000-foot look-down level, I don't have a whole lot of interest in Europe. As for the double dip, I prefer to think of it as the double drip. I think you're going to get a slow economic growth, but no double dip. There's been 38 recessions in this country since the 1880s. Only 3 of them have been double dips, and all 3 of those have been characterized by a mild first recession followed by a recovery attempt that fails, that fell into a much more severe secondary recession. And I don't buy the idea that the 07 to 09 recession was mild.
Okay, Jeff, nice talking to you today. Thanks for that. Raymond James is Jeff Saut joining us from St. Petersburg, Florida. We got a